Hi, I'm Lawrence Parker Brown. Welcome to the Inside Network. Joining us today to explore dividend investing, growth at a reasonable price, and how that mixes together for the Advisor Toolkit, we're delighted to be welcomed by Jason Yee from S&P Dow Jones Indices and Marc Jocum from Global X Australia. So Jason, if I start with you, what's a dividend index? What's a GARP index? And what's the difference in the methodology between the two?
Yeah, sure. Glad to be here, Lawrence. So dividend and GARP, we call them so-called like factors, strategy, smart beta, wherever the name. They are basically indices that blend in some kind of index construction that different from the broad market cap weighted indices. So take dividend, for example, as the name suggests, right? So a dividend index focuses a basket of securities with high dividend yield. So here we can use the S&P ASX 200 high dividend index as an example. Just on the high level, how we construct it? Well, we start from the S&P ASX 200 universe. We first do some of the simple size liquidity screening. We also incorporate a momentum screen, which I'm happy to talk about later. And then we look at basically companies with high dividend yield. And that dividend yield is on the forward-looking basis. So we use like the forecast dividend yield. And then select the top 50 stocks with the highest dividend yield within the S&P ASX 200 universe. And you simply do the weighting by flow market cap times the dividend yield. And we rebalance the index on the semi-annual basis. That's very important because the rebalancing keeps your index focused on the objective that, targeting group of stocks with high dividend yield. GARP, on the other side, is quite different. As the name suggests, so GARP, G-A-R-P, it stands for growth at a reasonable price. And this indicates that, you have growth characteristics and you have the reasonable price, which is the valuation, and we also incorporate some of the quality flavor in it. On the high level, if we use, for example, the S&P World X Australia GARP index, this index is looking at basically the S&P World. It's a broad benchmark that we look at the global markets, developed markets. And then we first look at the growth characteristics. So the earnings, the EPS growth, the SPS, the sales to per share growth. And then we look at the top 500 stocks first. So the top 500 stocks in the developed markets with strong growth characteristics. And then within that, strong growth basket, we look at things like the quality, ROE, return on equity. We look at leverage. We look at earnings to price, which is the valuation ratio where the reasonable price comes in. And we select the 250 stocks out of the 500 with strong quality value characteristics. And then we weight them by the flow market cap times the growth scores. Right. So you can see like step by step how we construct these indices are quite focused on the characteristics, the factors we're trying to target.
Now, Marc, if I think about advisors in practice trying to use ETFs to access a strategy like GARP, what does that look like?
I think it's a great question, Lawrence. And one thing that we have seen with ETFs is they have evolved over time. They were traditionally based on market cap, so you just based on size. But as Jason said, they're now going into these smart beta, all these different factors. And that's what makes ETFs so accessible. Strategies that once was reserved for active managers using these factors can be deployed using an index-based ETF. And the ETF market here in Australia is resonating with that. There's about $40 billion that are in these smart beta ETFs. That's pretty much quadrupled over the last 5 years. And over the last 12 months, around about 20% of the equity flows have gone into these smart beta strategies. And if you look again, 5 years ago, that's about 10%. So really, really broader participation and investors are resonating. And the great thing about an ETF that tracks an index, like a GARP-based index, like our GARP ETF, is you get access to these factors that Jason spoke about, and it's very transparent. You see the rules, you can see the liquidity profile, the transparent holdings. It's not a black box. And that's what we really love about it. And you're starting to see advisors using these ETFs to access these factors that were once reserved, like I said, for active managers, but they can just reduce the cost of the portfolio and target those factors very, very discreetly. So I think it's a fantastic innovation and one that we remain incrementally bullish on around ETFs providing access to GARP-like strategies or more broadly towards smart beta.
Brilliant. So Jason, drawing on Marc's message that there's clearly advisor and client demand, You and the team at S&P DJI have expanded the suite when it comes to GARP in particular. What was the thinking and what does that add to the local market?
Great question. Maybe I give you some of the history, how the GARP family evolves, right? So we first started with S&P 500 GARP that was launched 2019, so many years ago. And then we look at like extending the GARP franchise, the same methodology and framework, first, to the US mid-cap and the small-cap market. So the S&P mid-cap 400 and S&P small-cap 600. We all have the GARP indices. Then after we cover the US market, we look at it globally, right? So we have launched the S&P World x Australia GARP, which I just mentioned briefly about the construction. And then we look at, the local domestic market, like here in Australia. That's why we launched the S&P ASX 200 GARP. So what you can see here is like it's one same methodology or framework that's looking at growth at a reasonable price, but we're applying to different underlying universes. And we have been expanding the whole, we call it index family. And that means a lot to the local Australian market because now you have a set of toolkits, like if you want to understand the GARP strategy performance in the US, globally, in Australia, you have an index tool to refer to.
So Marc, you captured it very nicely. These factors can sit in the ETF vehicle. When an advisor is trying to think about dividend and GARP in practice, what sort of roles are they playing in a portfolio?
They definitely serve as satellite roles in portfolios. We definitely see most of the allocation is towards your core holdings. Think about a S&P 500 or S&P ASX 200. But these factor ETFs or these factor-based indices really help solve common problems. So for people who are a little bit worried about valuations, I mean, at the time of recording, the Australian market's trading in its top percentile in terms of valuation. So if you're trying to bring the valuation discipline down, but this whole idea of growth versus value, they sometimes dance to their own tune and they go through different cycles. The great thing about indexes is you can actually combine these factors into one. So for people who are looking to access income, as an example, you can overlay your existing strategy with a dividend-based strategy like what Jason was talking about, and that's through an ETF like our ZYAU ETF, or you can still have that growth posture, but just have that valuation discipline. Be focused on quality. And I think it really resonates well with advisors who want to communicate that with their clients, saying you're still getting access to growth because earnings growth derives long-term stock performance. Short-term, it might be a bit more psychological and fear and greed, but you're still not paying an arm and a leg for it. So as a satellite exposure to get valuation discipline, access to growth, and also income enhancements, I think these ETFs play really nicely as a satellite to portfolios.
So Jason, the demand is there, the evolution exists, so it's now incumbent on you and the team to think, how do we actually achieve this factor exposure through a really rigorous design of that index? Can you talk through the process and what your day-to-day looks like?
Yeah, absolutely. So if you look at like our role, at S&P DJI from the product management side, like we cover a couple of different spectrums from the index design, right? We speak actively with the market participants and we understand where the design is. And it really comes down to starting with research, right? To understand like what, for example, on the factor base, like, how the dividend factor works like here in Australia versus other market, it might be slightly different. And then we obviously, work closely with the research team to do a lot of, number crunchings to understand the historical performance, etc. But also, I think a key part of what we do is we launch indices, bring those indices to the live, right? So that after the index is launched, you can see like, these are ticker on the end of the days, and then you can see how things perform in the live market environment. And then we also spend a lot of time doing, like writing papers, doing a lot of index education to help the market better understand things like, passive to the active. You just spoke with Sue about SPIVA reports. And I did a lot of research about specific strategy focused, like, dividend and GARP. We all have paper published on that. And we speak actively to the market participants around this as well. So it's a very kind of dynamic, we cover different type of things. And I cover the APAC market, so, across the region, not just here in Australia, but we can see like different things across board. Yeah.
So Marc, to conclude this, we've thought about dividend and GARP as maybe being complementary sleeves that can sit in different satellites. For the advisor that's listening to this, why put them together? Is there a simple message that you want to share about portfolio construction and how practical this can be?
Yeah, I think a lot of these multi-base goals can be solved cohesively using index-based funds, because normally what happens when you're going for growth, you normally sacrifice on income and vice versa. But the great thing is you're seeing this demand for income-based strategies There's people who either retirees, peer retirees, or even wealth accumulators, they have a demand to build sustainable income streams. So by combining both a GARP-based index and a dividend-based index together, you can kind of kill two birds with one stone with giving that income tilt, right? By having that enhanced income factor, but not sacrificing growth. And that's where we're seeing a lot of advisors position them, like I mentioned before, as satellites to exist cohesively. And you can actually then tackle two goals at the same time. Maybe you might want to allocate a little bit more towards your GARP allocation if you have a young accumulator, whereas you might want to allocate a little bit more of that satellite position. And we kind of, use the idea of core and explore. Have your core-based portfolio, but the exploration should be dictated by the goals. And if you want to have 20 to 30% of your portfolio in that exploration bucket, maybe you want to gravitate towards your GARP for your growth-oriented clients or the dividend-based strategy. But again, total return is very, very important. So think about it from both the growth perspective or capital return and an income perspective as well.
If I can add on that, so the beauty of having indices available is that you have the backtest history, you also have the live history after the index went launched, right? So we did some of the research exercise. We look at, in the Australia space, for example, the S&P ASX 200 high dividend versus S&P ASX 200 GARP index. So Marc hit it right? So you have the dividend indices tend to be more value tilt, where they're more like, targeting lower valuation stocks. Where the GARP, you have the growth, you have the quality flavor in it. You also have a bit of valuation consideration in it. But the nice thing about this is like, if you look at the index by itself, they do have performance cycles, right? In some period, value may not perform well. In some period, growth, quality may perform well. But combining them together, we did an exercise looking at, for example, just blending them 50%. So 50% on the S&P ASX 200 high dividend, 50% on the S&P ASX 200 GARP, and we just rebalance on the semi-annual basis every month end in June and in December. We see this nice feature is you don't necessarily end up something just like the S&P ASX 200. You end up at something that complement in the different cycles. So for example, during the period of 2014 to 2019, that's when the period you can see a very much complementary performance environment where the dividend and GARP was in the opposite direction. But when you combine them together, we look at things like rolling 3-year returns, and you do observe that historically, the likelihood of outperformance increased dramatically. So if you just look at the S&P ASX 200 high dividend or the S&P ASX 200 GARP, on average, historically, we're looking at data from 2011. So on the monthly observation, right, it's about 50 to 60%, roughly 60%, give or take. But when you combine them together, because of the complementary nature, the performance becomes a bit more stable. You actually end up at something at the lower tracking error. So the tracking error is about 3 to 4%. But at the same time, your likelihood in the historical observations in terms of outperforming the S&P ASX 200 went up to about 80, 90%, I think 80% something. So that's where you can see these two index from the factor exposure perspective are quite different because of the nature, how they're constructed. But in the historical data, it shows how these two factors perform and how they can work together.
I think, Jason, Marc, you're telling a really compelling story about the index process, the toolkit that advisors have available to them. I think we could continue the conversation in the months and years to come.
Yeah. Thanks, Lawrence. Appreciate it.
Yeah, appreciate it.